Corporate profits. They're the lifeblood of our economy. When companies rake in the dough, good things happen. Jobs are created, wages increase, the economy booms. Think of it like this: a company's profits are like its fuel. More profits mean more fuel to power growth and expansion. But when profits dwindle, the economy sputters. Businesses tighten their belts, lay off workers, and investment dries up. That's why it's crucial to keep a close eye on corporate profits. They're a key indicator of economic health. The corporate profits after tax (CP) graph is like a financial EKG. It shows us the heartbeat of corporate America. When the line goes up, it means companies are making more money. That's good news. But lately, the CP graph has been painting a worrisome picture. The line is trending downwards, signaling a decline in corporate profits. This is a red flag for the economy. It suggests businesses are facing headwinds and struggling to maintain their profitability. So what's causing this corporate profit crunch? There are several culprits at play. First, inflation is eating into profits. Rising costs for raw materials, labor, and transportation are squeezing profit margins. Second, interest rates are on the rise. This makes it more expensive for companies to borrow money, putting a damper on investment and expansion. Third, consumer spending is weakening. With inflation putting a dent in wallets, people are cutting back on discretionary purchases. This toxic cocktail of economic challenges is creating a perfect storm for corporate profits. The stock market is like a fickle beast, easily spooked by any sign of trouble, and declining corporate profits are definitely a cause for concern. When companies start reporting lower earnings, investors get nervous. They see it as a sign of weakness and worry that the good times are coming to an end. This fear can trigger a sell-off in the stock market, sending share prices tumbling. And when the market falls, it can further erode investor confidence and slow down economic growth. It's a vicious cycle that highlights the interconnectedness of corporate profits, the stock market, and the overall economy. Section 5. The Investor's Dilemma: Navigating Uncertain Profit Waters. For investors, declining corporate profits present a tricky dilemma. On one hand, it's tempting to sell stocks and move to the sidelines until the storm passes. But on the other hand, market downturns can also create buying opportunities. Savvy investors know that it's often best to buy low and sell high. So, what's the right move? It depends on your individual investment goals, risk tolerance, and time horizon. It's crucial to do your research, consult with a financial advisor, and make informed decisions based on your specific circumstances. Section 6. Eroding Confidence: The Ripple Effect of Declining Profits. Declining corporate profits don't just impact Wall Street. They also have a ripple effect on Main Street, eroding economic confidence and potentially leading to a recession. When businesses are struggling, they're less likely to hire new workers or give out raises. This can lead to higher unemployment and stagnant wages. Consumers, sensing the economic uncertainty, may also tighten their belts and cut back on spending. This further weakens demand, creating a vicious cycle of economic contraction. Section 7. Government Intervention: A Helping Hand for Corporate America. Governments often step in to try and stimulate the economy during times of declining corporate profits. This intervention can take many forms and is often a topic of heated debate among economists and policymakers. They have a variety of tools at their disposal, including lowering interest rates, which can make it cheaper for businesses to borrow money and invest. This is often one of the first measures taken to encourage economic activity. Cutting taxes, putting more money back in the pockets of consumers and businesses, boosting spending and investment. Tax cuts can stimulate demand by increasing disposable income and increasing government spending, which can create jobs and stimulate demand. This can include funding for infrastructure projects, education, and healthcare, which not only create jobs, but also improve the long-term economic prospects of a country. However, government intervention is not a magic bullet. The effectiveness of these measures can vary depending on the economic context and how they are implemented. It can take time for these measures to have a meaningful impact on the economy. Patience and careful monitoring are essential, as the benefits of such interventions may not be immediately apparent. Additionally, there are always risks involved. Government intervention can sometimes lead to unintended consequences, such as inflation or increased national debt. It's a delicate balance that requires thoughtful consideration and strategic planning. History has shown us that while government intervention can provide a much-needed boost during tough times, it is not without its challenges. The key is to find the right mix of policies that can support sustainable growth without creating long-term problems. In the end, the goal is to create a stable and prosperous economy that benefits everyone, from large corporations to small businesses and individual consumers. The journey is complex, but with careful planning and execution, it is possible to navigate through economic downturns and emerge stronger. Section 8. Consumer spending, the fuel that drives corporate profits. At the end of the day, corporate profits are largely driven by consumer spending. When people feel confident about the economy, they're more likely to open their wallets and spend. That's why it's crucial to restore consumer confidence if we want to see a rebound in corporate profits. This requires a multifaceted approach that addresses the root causes of economic anxiety. Policymakers need to get inflation under control, create jobs, and foster an environment of economic stability. Only then will consumers regain the confidence to spend freely and fuel corporate growth. Section 9. Global headwinds. External factors impacting corporate bottom lines. The global economy is more interconnected than ever before. This interconnectedness means that events in one region can have far-reaching consequences across the globe. What happens in one part of the world can have a ripple effect on businesses everywhere. This interconnected nature of the global economy means that companies must be more vigilant and responsive to changes. Today, several external factors are creating headwinds for corporate profits, including the war in Ukraine, which has disrupted supply chains and driven up energy prices. The conflict has led to significant logistical challenges, making it difficult for companies to maintain their supply chains and manage costs effectively. China's economic slowdown, as the world's second-largest economy, a slowdown in China can have a significant impact on global demand. This slowdown affects not only Chinese businesses but also international companies that rely on Chinese manufacturing and consumer markets. And a strong US dollar, which can make American exports more expensive and less competitive in global markets. This strength in the dollar can lead to reduced sales for American companies abroad, impacting their overall profitability. These challenges highlight the need for businesses to be agile and adaptable in the face of global uncertainty. Companies must develop strategies that allow them to quickly respond to these external pressures, whether through diversifying their supply chains, adjusting their pricing strategies, or exploring new markets. In addition, businesses should engage in continuous learning and networking to stay informed about global trends and potential risks. By attending international conferences and trade shows, corporate leaders can gain insights and build relationships that may help them navigate these complex global challenges. Leveraging technology can also play a crucial role in mitigating the impact of these external factors. Implementing AI and machine learning can help businesses predict market changes and optimize their operations accordingly. Digital transformation initiatives can enhance efficiency and resilience, enabling companies to better withstand global headwinds. Finally, adopting sustainable business practices and engaging in corporate social responsibility can not only improve a company's reputation, but also create long-term value. By supporting local communities and focusing on sustainability, businesses can build stronger, more resilient operations that are better equipped to handle external shocks. In conclusion, while external factors can pose significant challenges to corporate bottom lines, businesses that remain agile, informed, and innovative will be better positioned to thrive in an ever-changing global landscape. Section 10. The road ahead. Predictions for corporate profits and the economy. As we navigate through these uncertain times, understanding the potential future of corporate profits and the broader economy is crucial for businesses, investors, and policymakers alike. Predicting the future is a fool's errand. Yet, despite the inherent uncertainties, we can still derive valuable insights by closely examining current trends and economic indicators. By analyzing these data points, we can make some educated guesses about what lies ahead for corporate profits and the economy. This involves looking at a variety of factors, from consumer behavior to global economic policies. Most economists expect corporate profits to remain under pressure in the near term. Inflation remains stubbornly high, affecting both consumer purchasing power and business costs. Interest rates are still rising, which can dampen investment and spending. Central banks around the world are taking measures to control inflation, but the effects are yet to be fully realized. Consumer spending is showing signs of weakness, reflecting the broader economic challenges. This decline in spending can have a ripple effect, impacting businesses across various sectors. However, there are also reasons for optimism. Despite the challenges, some sectors are showing resilience and potential for growth. The job market remains strong, with employment rates holding steady. This strength in the labor market can provide a foundation for economic recovery. Additionally, inflation is showing signs of cooling. If these trends continue, it could ease the pressure on both consumers and businesses, leading to a more favorable economic environment. We could see a rebound in corporate profits and economic growth later in the year. This potential recovery will depend on various factors, including policy decisions, global economic conditions, and consumer confidence. By staying informed and adaptable, businesses and investors can navigate these uncertain times with greater confidence and preparedness. Section 11. Stay informed, stay ahead. Subscribe for expert insights. The world of finance and economics is constantly evolving. Staying informed about the latest trends and developments is crucial for making smart investment decisions. That's why I encourage you to subscribe to your platform newsletter channel for expert insights and analysis on corporate profits, the stock market, and the economy. We'll cut through the noise and deliver the information you need to navigate these uncertain times and achieve your financial goals. Don't get left behind. Subscribe today.